Okay, so we'll be talking about financial engineering. All right, financial engineering is the study of market structure. All right, and what is market structure? Market structure are those underlying pattern or direction a particular market wants to make. We have various markets in the forex market. We basically have the euro US dollars, we have the GBP US dollar, we have various currency pairs. Okay, so market structure is the pattern a particular market wants to make. All right, they have a host of many patterns we'll be looking at. So now, how do we treat market structure? We basically follow the trend. When the trend is up, what are we supposed to be doing? We are supposed to be buying. Okay, when the trend is down, what are we supposed to do? We are supposed to be selling. When the trend is sideways, all right, when they say a trend is sideways, it's consolidating. That means it is moving in a range. Okay, it's moving in between highs, that's a resistance and a support. All right, so it's consolidating. So what are we supposed to do? We are supposed to wait for a breakout of that range, and then we either sell or buy. All right, so remember this is very basic. So now let's just quickly look at these patterns. All right, these are all market structure patterns. All right, these are all market structure patterns. So now I want to take this into consideration. Now this is an uptrend. Why do we say this is an uptrend? Remember the definition of an uptrend: when the market is making sets of higher highs. This is a high, okay, and then this is a low, okay. Now this is a high, and then this is a what? This is a low. So what do you observe? The market is making sets of higher high. This high is higher than this high, all right, and then this low is higher than this low. Then whenever the market is making sets of higher highs and higher lows, we see the market is in what? An uptrend. So now this is a downtrend structure. You are following now, right?
Yes.
Now this is a downtrend structure. When you see the market is in a downtrend, the market is making sets of lower lows and lower highs. So this is a high, right? And then this is a high. Alright, what do you observe about this high and this high is that this high is lower than this high. Alright, what do you observe about this low and this low is that this low is lower than this low. Okay, so that is what is meant by trending market. So when the market is trending up, it's making sets of higher highs. You see this high. If you want to measure this high to this high, they are not in the same range. This one is higher than this one, so we see the market is in what? An uptrend. Okay, so now when we are looking at this market, we are seeing that the market is making sets of lower highs. This is a high, this is a high. Okay, but the difference between this high and this high is that this high here is lower than this high, so we say this is a downtrend. Okay, so now in when the market is moving up, there are ways that we can trade this particular upward moving market. So these are the various ways in which we can trade this upward moving market. Now we can do what is called a break and retest, right? Because remember when we're talking about price action, we say whenever a roof or a high is broken, the market comes back to retest that high. Okay, now let's say this is our high, right? We have not seen all of this. Okay, this is our high, and we mark our high. Okay, this is our high. Okay, so now whenever the market breaks this our high, this is our breakout. So let's draw this market. So the market went up, came down, all right, forming our N. Okay, remember all these turning points can be seen as N and V's. Okay, so when the market does not just make these N's and V, they make these N's and V in reaction to something. All right, that's it, because the market cannot just on its own turn. It must be turning in reaction to something. All right, so whenever it turns from an upward direction downward, it forms an N. Okay, if you look at this red, these are highlighted in red. It looks like an N, right? Whenever it turns from down to up, it forms a V. Okay, it forms a V. If you look from year to year to year, it looks like a V, right? So now our aim as trader is to catch one leg of this structure. All right, our aim as financial engineers is to catch one leg of this structure. Let's say the market started doing something like this, all right, and we know it's going to form an N, but it has not formed the N yet. So our aim is to catch this N. We should sell so that we'll catch this N. Okay, let's say now the market does something like this, for example, and we know that the next thing is going to do like this. All right, it's going to do something like this. So before it does this, okay, our aim is to catch this movement and make money from that movement. right? Because how do we make money in the financial market is to catch, is we make money by price volatility. What does it mean? What do we mean by price volatility? We simply mean price movement, okay, in a particular direction. So for you to catch a directional move, you need to come in early. All right. So now let's just see how we can catch these moves, okay, using what we know about market structure. All right. These are patterns that market must obey. All right. So now see, this market has made a high, okay, and now have you seen this market has made a high? So we'll mark out this high. All right. We mark out the high. So once a candle close above this high, we say it is a valid breakout. The market has broken this high. So what do we expect when the market breaks a high? We expect the market to pull back and retest this high so that we'll be able to enter somewhere around here. All right, because we know there's going to be a V. All right, it's going to be a V. So the V has not happened yet, so we'll enter here for a buy so that when the V happens, we are caught in profit. All right, you understand that? So now let us do it for downward market structure. This market structure are ways that market move. All right, this is how market moves. This is how it is. Market is destined to behave. Why does market behave this way? It's because market like to feel orders. All right, let's say this market is moving up, it's trending up, obviously. Okay, it's trending up, obviously. But after breaking this high, instead of it continuing higher, it choose to pull back, all right, to fill order because it must have missed some orders. You know what moved this market, this forex market, is what? Demand and supply. When there's much demand for a particular asset, the market tends to go upward. All right. When there's less demand, the market tends to go down. So, okay, let's look at it this other way. When people are buying a particular financial asset, the market goes up. When people are selling a particular financial asset, the market goes down. So now, when they say big money in forex, it means the people that have enough liquidity. You know, in economics, when I say liquidity, we mean money, enough capital to move this market. You know that the $100 in your account cannot move this market by one pip. It cannot. All right, it's like $1 million that can move this market by one pip. So now, those people that have the liquidity to move this market in a particular direction, let's say, and what affects them the most is orders not being filled. So let's say they have seen this, they have moved the market and broken this high. Okay, they have moved the market and broken this high, and they discovered that not all of their orders were filled because they placed some orders here, some buy orders here. Okay, they placed some buy orders at this point. Let's say this point is point one. Okay, this point is one. So now they placed some buy orders at point one. So the market came because of other activities by other traders and broke this point one and collected some orders, but not all the orders were filled because of what is called gap. Gaps happen in the financial market a lot, and apart from that, some orders were not filled. That's basic. Some orders were not filled. So what do you think they will do? Because they have the money to, they will push down this. The overall direction of this market is upward. The bias of this market is upward. All right. And now, because they have been able to break this high, and then some of their orders were not filled, they will have to start selling because they have the money to sell. So when they sell, they hope to come and fill the orders that they placed there initially to move this market upward. They want to fill that order before they now continue up. So now we are followers. All right. So when we see that the market has come back to this high, because there's a law in forex, whenever a support or a resistance is broken, it comes back to retest at that resistance or support as a floor or ceiling. All right. Now take for example. Now we have this as our previous ceiling. All right, as our previous ceiling. All right, this very zone as our previous ceiling. Now this zone has been broken. What do you expect? The market is trying to come down back to this zone. It can do two things. It can either break this zone and continue down, or it can bounce off this zone. All right. So, but what we know is that the market has broken this demand zone because of demand. All right. The orders here could not push the market downward, so the market broke this zone, telling us that they were buying orders here, orders that are supposed to push this market upward. So now, as those orders have been triggered and have pushed this market upward, some of those orders were not filled. So what do you think the market makers will do? They'll bring down the market back and try to fill all those orders before they continue up. So we are followers. What do we do when they bring back the order to fill, when they bring back the market down, so that they will be able to fill all these orders? We buy alongside with them, and then we make money. All right. As I told you earlier, we want to complete this leg. We basically know that when the market goes up like this, it will come down. All right. But we want to know when it's going to come down. All right. There are zones when this market will come down. The market cannot just we cannot just see market going up without selling. We'll be losing money. You don't know the market want to continue upward till maybe 100 pips. Maybe at 50 pips you are selling, and then 100 pips in now turn. Maybe after you must have lose a lot of money. You are putting your stop loss here. Market is going up. You hit your stop loss. You have lost money. You hit your stop loss. Close that. You now do it, hit your stop loss. Now you have lost a lot of money. I don't know if you understand. That's just basically it. That's just basically it. So now if market is going downward, now for example, it has made this V, all right, this V or a low, all right. What do we expect the market to do? Now, the market has shown us sign by breaking this low. It has broken this low. Okay, it has broken that low. So because some orders were not filled, what do you expect the market to do? To come back to pick those orders and then continue in the original direction. So we should be entering somewhere around here so that we'll follow the market makers when they are continuing in the original direction, which is sell, and we make money alongside with them. I don't know if you understand. So that's this market structure. This is the market structure that we are seeing. So these are other advanced market structures that we have. Okay, like this structure now. When the market is, this is a ranging or consolidation market. This is a range of constitutional market. You could notice that the market is moving in between roof, that's a ceiling, and then a floor. Moving in between roofs and floor, roof and floor, roof and floor. Okay, so I don't usually advise you to trade this because you don't know how long a floor or ceiling is going to hold. But if you're a professional, you can trade this. Whenever the market comes here, you buy. Whenever the market comes here, you sell and make money. Comes here, you buy. You understand? But what I usually advise one to do is that we wait for the market to either break to the downside, so that when it breaks to the downside, we retest and then we follow the market makers, or we wait for it to break to the upside, and then when it breaks to the upside, we retest because orders were not filled, and then go to the upside. So we are hoping to enter somewhere around here or somewhere around here, as the case may be. I tell people that the forex market is not gambling. What we are basically doing is that we are reacting to what price is doing. All right, we're basically here to react to what price is doing. We're not here to gamble. We're not here to guess where price wants to go. We're here to react to what price wants to do. Okay, now so this is another pattern. It's called a double bottom, and then this is a double top. So now the market has made something like this. All right, it has made a V bounce. All right, telling us here that there's a strong. I told you that the market cannot just make V's like this for no reason. There's a reason why the market made this V. We don't know the reason. So what do you expect when the market comes back to this zone again? It's for it to that reason to still apply and make the market to go up. So what are we supposed to do? We are supposed to enter. We are supposed to find reason to enter here so that we'll buy here. So that when the market goes here, there will be profit for us. Okay, there will be profit for us. So now this is what is called a double top. All right, this is another market structure pattern. This is called a double top. So now when the market has done an end bounce, we know that okay, it has given value to this area, that there's something about this area that is valuable. So whenever the market comes back to this area, we look for reasons based on what I'm going to show you on the live chart to enter for a sell. All right, so that we should follow the way the big money is basically going. Now, so now we have this market structure. All right, this market structure is basically an uptrend market structure, but in this case, it is respecting what is called a trend line. All right, it is respecting an imaginary trend line. I like calling it upstairs. All right, it's an upstairs, it's taking you up. All right, so you notice price is moving. We know what we basically do in forex market is to follow pattern. Price has done this first time. We say it's normal. It's normal. Now it does this second time. Notice it's following an imaginary step. It's stepping up. You can see an imaginary. You can notice that the market is following an imaginary pattern. All right. So the market following an imaginary pattern and is making sets of higher highs. All right, and then making sets of higher lows. We can say this is an uptrend, and then we can draw an upward trend line by connecting. Trend lines are basically support and resistance, but they are drawn diagonally. Okay, they are diagonal support and resistance. The support and resistance that you were taught are basically this and this, that of the ranging market. All right, this is a resistance and this is a support. Whenever the market comes to a resistance, it's being resisted downward so that will form an end bounce, and then whenever it comes to a support, it's being resisted upward, so that we have a V bounce. So this is what we know about it. So when these support and resistance are arranged diagonally, what do we have? It's the same thing. What do we have? We see the market in an upward channel. All right, it's called upward trend line. So it's the same thing. So when the market is coming down to these lows, because this is also a low, what do we expect? The market to bounce up. Whenever it comes to this low, we expect the market to bounce. So whenever the market is coming to these lows that we have been able to draw in this region, where we've been able to draw with an imaginary line, what do we expect the market to do? We will look for reason to buy, so that we enter where the big money is. Right? Because this has proven to us by respecting this trend line that this is a region where we should be looking for buy based on past principles. Remember when we talked about price action? We see price action is looking at the past to determine the future. Looking at the past to determine what? The future. So that's what price action is basically. So we have talked about, now let's talk about downward. This is downward trend line. Alright, downward trend line. The market is making sets of lower lows and lower highs. Okay, lower lows and lower highs, lower lows and lower highs. Okay, so because we have noticed that the market is moving in this way, so we draw a line. All right, we draw a line so that whenever the market comes here again to this place, this line, this imaginary line that we have been able to draw, because we have the tools to draw them out within our chart, we will look for a reason to sell. All right, I tell you that we don't just buy and sell in this market. We look for reasons to react. All right, once we see a particular formation, maybe an engulfing pattern or whatever we use to identify a reason to sell, we sell. All right, we react to what the market wants to do. So that's basically it. So now we have this other advanced pattern. This one is called a mixed double top, a mixed double bottom. All right, mixed double top bottom, and then this is a mixed double top. They are almost the same thing like this. All right, so the market did not have the effrontery to come and retest this zone. They could not see now the double top. The market has proven that this place is a resistance. Okay, but now the market did not have the effrontery to get back to that region. It fell. All right, that's a miss. They call it miss double top. Now this is a miss double bottom. Now the market is obviously coming down. It's obviously coming down. All right, it came down. All right, and then it's obviously coming down, but it doesn't have the effrontery to reach this level. So we call it a miss double bottom. All right. So now that's that. So now we also have this break of trend line. All right. Now we have drawn our perfect trend line. Okay. We see this our upward trend line, and then we see the market doing something like this, not respecting this our trend line. Rather, it came down and broke this our trend line. I'm talking about this. So I'm talking about this scenario. Okay. It came down and broke this our trend line and came up and then went down. So this is a pattern. It happens in the forex market. These are there, but don't expect them to happen this perfectly. But when we go to the real chart, you see how exactly they happen. Don't expect them to happen this perfect. All right, but this is what it is. Okay, now this is an upward trend line. This is an upward trend line that was defiled. Right, this upward trend line was defiled, and then what do you see? The market has broken an upward trend line. Therefore, we see a downward push. Okay, our bias now becomes downward. So whenever the trend line, an upward trend line is broken, our bias shifts, because if something is going up and it defiles an upward movement, what next? It's a sign that the market wants to do what?
Want to sell.
Good, wants to go down. All right. Now, see, the market is going downward, obviously. All right, and it's respecting our trend line. Okay, but now our trend line has been defiled, telling us that we need to change our bias. We need to change our thinking of the market. And if the market is no more respecting our invisible line, there's therefore reason for us to think that the market wants to start going upward, and then we can look for pattern like this. All right, break of trend line structures and retest and whatever. So these are all the patterns that we have in the forex market. So now let's just look at them individually. Okay, I want us to look at them individually. So now these are the basic structures. Okay, these are the ones that we just talked about. Market is going. Okay, let me use that tool again. Now these are the basic structures we just talked about. Market is going up and then it forms an N. We know whenever an N is broken, the market comes down to form a V. All right, we can look at it like that. So we want to enter when the market wants to start going up. All right, we are looking for all reason to enter, and it happens within this range. It happens around this level where the N, that's the pinnacle of the N, the peak of the N, the sharp point of the N is. All right. Now, if we are looking for this kind of pattern now, for example, all right, the market has made a V, okay, and then that V was broken. Whenever a V is broken, the market comes back to that V to retest for an N, okay. When I say N, I mean the market was previously going up, it turned, okay, because this level is has become a resistant to the upward movement of this particular market, right? It's market structure. This is how markets are designed to happen. And earlier I've told you why market moves in this direction. Okay, now see, market was going up, it came down, telling us that there's something about this zone that is not allowing the market to pass this level. Now we now see something very unusual. Market broke this level. It has broken this level. So when you break that level, we tell you that okay, this level has been defiled. Then what are we looking for? Continuation to the upside, all right? Continuation to the upside, but nothing is guaranteed in the foreign market. The market can still come down and continue going down, all right? It's 100% possible. 100% possible. What are we here to do? We are not here to guess or to prove that this is not going to happen, okay? What we are going to do here is to react based on what I'm going to teach you. To react that this market is going to continue up following this upward structural pattern. Right? Following this upward structural pattern. I don't know if you understand. We're here to react. Okay, when we see the market do this, all right, it has made an N, and then we see that this N has been broken. All right, this N has been broken. And then now, because of the market structure that we have in our head, that whenever an N has been broken, the market comes back to this area or the sharp point of that N to now form a V. What should we expect? Because we already know this structure. We have learned about this structure. All right. So what should we expect? That the market at this, we should be looking for a reason to buy at this point. Right, reason to buy this point. Now we know that whenever a V is broken, now this is our 100% V, okay, and now this V is broken. The V has been defiled. Candle closed outside of this V. All right. What do we expect? The market to come back and not break this V, because we know a market structure like this, not break this V, rather comes downward. So whenever the market comes back to this place, because we know, all right, that whenever the market comes to the place, we see some certain reactions. We know that okay, the market is trying not to break this place, it's rejecting this zone. All right, we call it when we see wicks, that's wicks happening here. We see some kind of wicks happening here. We say, oh, the market is finding it hard, all right, to break this zone because of it has previously broken this zone. Now it is coming back to this zone. Instead of it to break back in, it cannot. All right, it's finding it hard to break back in. So we now sell. All right, we sell. All right, bearing in mind with what we have seen with confirmation, with the right confirmation. All right, now see this other market structure is market going down, it went up. All right, market going down, all right, it went up. Once this has happened twice, we can now draw a line like this and say, okay, the third time this will happen, we would sell. The third time this will happen, we will buy. All right, but I don't want us, because this is a break and retest course, I don't want us to look at that. Rather, we should be waiting for market to do something like this, either break to the downside and then come back here to retest this floor. All right, these sets of V's. All right, so that we'll look for a reason to end. All right, or the market to break these sets of ends. All right, so I will look for a reason to V. You see, that's how simple forex is. There's nothing complicated about this whole thing, but it's very, very technical. All right, very, very technical, but it's something you can understand. So now let's just look at this once again. The market is obviously trending downward, okay? And remember, when we say a market is moving downward, it's making sense of lower highs and lower lows, lower highs and lower lows. So, but this is how it looks on the chart. Sets of lower lows and lower highs, lower lows and lower highs, okay? That's how it looks on the chart. Okay, now see, let me just draw the what we're used to. Now see, market has broken this zone. All right, this is exactly what we want to do here. We want to do what we have been seeing. Okay, market has, let me just draw it over here. Market came down and then went up. It made a V, right? Now market has broken this V. Okay, what do we expect when the market comes back here? We want to end this market. All right, so we want to end the market. So we look for a reason to complete the other leg of the market to make it an end. Okay, to complete the structure of this market. All right. Now see how it looks on the real chart. Market has broken this zone. All right, it has broken this zone because candles closed. You see this candle? This very candle closed below this level. All right, now market has gone back up into this area, this very area. Okay, now what are we looking for? We're looking for reasons to end, but it's not. You see how it looks in this other scenario. Other scenario, you see how clear it was in the other scenario. In this scenario, it's very clear, but I tell you, don't expect the thing to be clear like this. Right, this not everybody will be successful in the forex market, but if it's this way, it's technical. All right, you see the reactions and everything. Okay, now see this other this thing. We have something like this. All right, we have something like this. We have something like this. This I'm trying to mark the zone. Now market has broken this zone. Has broken this zone, and now came up. It does not even have the power self to get to this zone. It started retracing. All right, started retracing, and it broke. It created another zone here. Remember, this is a V because the market came in, coming down, went up. It's a V bar. Yes. So now we can say this is another zone. So whenever market has broken this our zone. Oh, it has broken our zone. How do we know it has broken our zone? Because body has closed. This is weak. This is basically weak. All right. So now I'm looking for when I want to draw this zone correctly, I draw it from here like this. All right. Now market the body has broken this zone. Okay. Now let me just make that one a little bit clear so we understand. Now see, this is our V. Okay. Market has broken this zone. How do we know it has broken this zone? Because this very candle closed below this level. So what are we waiting for? A V bounce. You know, an end bounce. Why do we see an end bounce? Because this was a V. Market has broken the roof of our tip of the V. All right, this is our tip of the V, and then we are waiting for the market to come back to this zone because whenever a V is broken, it forms an end. Right, so that's what we're looking for. Right, that's that. So now this is trending downwards, just exactly what I just told you now. You see how the retest are done. See how the retest are done. Market was going, well, it formed like a V here. Okay, the V was broken by a candle closing below this value area. How do we know? Because see where the body stopped. All these are wicks. All of these are wicks, right? Let me have something there to really determine all of what we are saying. You see, these are wicks. These are wicks, okay? These are wicks. Now, market has broken this area of body. This is where the body stopped. This is where the body is stopping. Okay, so we mark out where the body is stopping. First of all, that's very important for us. Now, market has come down here, went up, telling us that there was something about this zone. But now, market has defiled this zone. Right, has defiled this zone. So when next market come back into this zone, what do we look for? And these are 4 hours candles. We trade this strategy using the 4 hours candles. Okay. So now, trading these 4 hours candles, you observe that it took 4 hours for the market to come back to this zone. It took some couple of hours anyway for the market to come back to this zone. Okay, let me draw the zone from body to wick. We call this a zone. From body, from the start of the body, that's from here, all right, to here. It's called a zone. Let me draw it in this clear market place. From here to here, it's called a zone. So if I'm to draw the zone, I'll draw it like this. Okay, I'll draw a zone like this. So this is the area where market break this zone. You're hoping the market will come back to this zone and go down. That's the zone. You want to draw the zone. So now market has been able to break this zone. It's coming back to this zone. Around this zone, what are we looking for? Reason to sell. All right. Reason for the market to end. All right. Now market has broken this. Now it has done something like this. It went up. All right. Now it has broken this zone. All right. Now what are we looking for? Market to come back to this zone, and that's for others to come back here so that the others will feel and go. That's just how market moves. So enough of all of those emphasis. Look of all of those emphasis. Okay. So this is for the upward market structure. Upward market structure. Let me just quickly do a quick one to that effect. Now we see market moving up. It forms an N. Okay. Market broke that N. Now market has come back to that area so that it can go up. So this was not clear enough, but that's what it is. You understand now, right? So we'll look for reason around that region for us to buy. That's what it is. Now this is trending up. You see the break. It breaks this zone, and then what does it do? It come back to retest. It break this zone. What does it do? It come back to retest. It break this zone. This zone. It come back to retest. That's just basically what we are looking at. So now, what do we look for in a ranging market? When they say market is ranging, it's moving in between resistance and support. Resistance and support, resistance and support. What are we looking to happen in the ranging market? We are waiting for the market to either break to the downside or the upside. We wait. This strategy, we don't trade the support and resistance. That's the upward and downward bounce and whatever. We wait for the market to break and retest and continue. Break, retest, and continue. That's what we're looking for. So this is where we are going to see it more clearly. Now see, the market was in consolidation, was in ranging, okay? Now it broke this level, this downward range. Market has not been able to pass this region for a very long time. All right, let me take out my drawing shoe. Now notice we have these two regions. We have the upward and then we have the downward region. Okay, for some time, for some couple of hours, market has been moving like this. Okay, market has been moving like this. Market has been moving like this. And move like that. Only now that the market broke this region. After it broke this region, what do we expect? Market to come back and retest this region so that we can sell, or come back and retest this region so that we can sell. All right, that is exactly what we're looking for. All this why you could not break this downward region for a whole. You want to check this at 4 hours candles. 4 hours candle. This is like 3 days, 4 days, 5 days, 1 week has been respecting this zone, but now it broke the zone. Tell you that there is pressure to the downside. And now, after it has broken this supposedly support, yes, support, orders were not filled. So the market usually comes back to fill, complete those orders so that it continue in that direction. That's the idea. So now we have market upward, downward, upward around that region, downward, upward, downward. Okay. Now market has broken this zone. Now what do you expect? Some retests. Want to see this retest. Okay. Want to see market do something like this so that it continues in an upward direction. That's just the general knowledge I want you to have of market structure. Right. So now we will be looking at our chart so that we'll get a full overview of all of this so that we can go into in our next class we can go into trend lines. Okay, but I want us to master this break and retest first of all. Right, then we can go into trend lines. Trend lines are very easy. I'm going to trend lines. Okay, in our next class. Or should we look at trend line? Okay, let's look at trend line. Let's just quickly look at trend line. All right, we'll look at after we have now talked about break and retest. Now let's look at trend line. Okay, so this is an advanced pattern. Okay, it's an advanced pattern. It's called trend line. So trend lines are basically imaginary lines. Okay, now we see the market doing this. It's stepping up. Basically, it's doing what? It's stepping up. How do we know it's stepping up? I'm going to tell you. All right, it's forming highs. This is a high. All right, this is a high. But the difference between this high and this high is that this high is higher than this one, but this is a low, and then this is a low. But the difference between this low and this low is that this low is higher than this low. And then what do we tell you? What do we tell you guys in our previous class about when the market is making sets of higher highs and higher lows? That the market is moving in an upward direction. Whenever the market is moving in an upward direction, what do we look to do? Sell or buy? When market is moving up, what do we look to do? Sell or buy? We buy. That's very, very good. When market is moving downward, what do we look to do? And when market is moving downward, what is the characteristic of a downward moving market? It's making sets of lower highs. This is a high, all right. Whether it is upward or that is a high, all right. But the difference between this high and this other high is that it's making lower highs. Okay, it's making lower highs. So we now see the market is it's obviously moving downward. Okay, obviously moving downward. All right. Now in an upward market, we connect the lows. In a downward market, we connect the highs. Okay, because in an upward market it's forming a V. So we are meant to connect the tip of this V. All right, because whenever the market is retesting a resistance, all right, an imaginary resistance, resistance are basically imaginary lines, because we have noticed that market is respecting this zone that's respected this first time, that is respecting an imaginary structure that seems to impede the movement of this market further downward. All right, if something is impeding me from coming further, let me say I'm coming downward, but something is impeding me from coming further downward, all right, it makes me to go up. What do we call this? The support.
Support.
Yes. So now in an uptrend, we have this imaginary support that tends to impede further movement downward. All right. So it has done the first time. It has happened here. All right. We see that something impeded the movement from moving downward. Now it has happened here again the second time. So what do we simply do? As for instance, that we come here and connect this. Since it is the market is moving higher, all right, we come here and connect this to this, so that in the future whenever the market come here we can look for some reason to do an end bounce, that for the reason to be for the market to be for the structure to be impeded. I don't even know if that's correct. All right, for market not to continue, the only thing is that if market break this structure without looking for sales, all right, we know that okay, this structure has been defiled. All right, this structure has been what? Defiled. So we start looking for sales. All right, but so far as we see reason for us to enter for a buy in this structure, we will continue to enter for a buy. So far as the market continually respect this structure, we continue to buy. All right, we continue to buy. We continue to buy so as long as possible until the market now defiles the structure. Then we can now change our bias to sell. All right. So that's the same thing for this other direction. That's exactly the same thing for the other direction. So now, when we see this thing happen twice, we can now draw a trend line. So for us to draw a valid trend line, we need to see market do this. We need to see market make, first of all, we need to see a higher high. This is a high, and then this is a higher high. Okay. We need to see market make a low, and then a higher low. All right. So now we'll connect those lows together, so that we'll now look for a region in the future where market can come to and bounce off of. All right. When we see right confirmation in this region, we buy. Right. If we don't see any right confirmation, market breaking this region, we calm down. We wait for the market to break, and then we see reasons to sell. Right. Because we are not here to gamble. We are here to react to what market wants to do. Okay, we're here to react to what market wants to do. I want all of you to say it alongside with me. We're here to react to what market wants to do. The very moment you start gambling in this market is when you become a losing trader, because nobody can successfully gamble in this market. We are here to react. We are here to work with what we can see. All right. We trade what we see. We don't trade what we feel. Okay. We trade what we see. We don't trade what we feel. Basically. So now this market is now making sets of lower highs. Now this is market. It went down. We are observing. Patience is the key. Patience is the key. We observe a lot in this market. Okay. We observe a lot in the market. Market has made a low, okay, and has now made a high. We want to see if this low will be broken, and then when this low is broken, we say, oh, market has started doing something as if it's a downtrend. All right, so that when market comes back to this place, this area, all right, it will come down. We will believe that it will come down. Okay, so doing that now, we'll discover that it is forming, it's trying in a way, giving us kind of an imaginary reason to sell whenever market comes to that imaginary region. All right, an imaginary region. So now it has because of how it's stepping downward. See, the market is stepping downward. Okay, because of how the market is stepping downward, we drew our line connecting these lows, sorry, these highs. Remember, this is very, very important. In a downtrend, you connect the highs. All right, you connect the highs. All right, in an uptrend, you connect the lows. Please don't forget, very, very important. Okay, very, very important. In an uptrend, you connect the lows. All right, in a downtrend, you connect the highs. Okay, so now when the market now comes here, we assume that the market wants to form a high. All right, but we react to what we see. All right, whatever market does around this place. Remember the tutorial we had about candlesticks. Whatever market does around this place, that's what we are going to use in order to react. The market wants to either go down or break this zone, because two things can happen. Whenever markets come here, it can either break. All right, when it breaks, we know, okay, market wants to continue up. Right, when it respects, we see some signs of weak, some rejection, then we know that, okay, market wants to respect this zone so we can sell. So now we have this market pushing upward. Let me just quickly do that's proving to us that it's respecting an imaginary line, okay, an imaginary support. So remember, in an uptrend we connect the lows, so we connect two lows waiting for the third low potential. We don't say third low, third potential low to form. When this low when it comes here, we expect that the market goes upward. Okay, and then how do we know that this market is moving upward? It's because it is breaking highs. Okay, it's breaking highs. In fact, before I will even draw this, before I will even classify this as a low, before I will ever classify this as a low, I need to see the market break here. That does this. After it does this, I can say, okay, this is a valid low. Before this became a valid low, before I can even draw a trend line in this zone, I saw that the market broke this. It did this. Okay. Before I said, okay, this is a low. Before I will even call this a low, so that I can use this for future market bounces. All right. Future market bounces. All right. I need to see market break this. So I say, okay, market is breaking highs, meaning it's going upward. All right. So now let's look at the downward side. Before we even consider this, as a valid high, so for us to draw our trend line structure, okay, for us to consider this as a valid high, for us to draw our trend line structure, we need to see that the market is breaking this low. This is a low. This is a low that's formed. Okay, we need to see that market has broken this low for us to verify that, okay, this is lows. The market is trying to make sets of lower highs and lower lows. Okay, so it's trying to make sets of lower highs and lower lows. So now see, before we even draw a trend line to touch this particular low, to say, okay, this is a valid what? This is a valid. I told you, in a downtrend we are connecting the highs, in an uptrend we are connecting the lows. Okay, we are connecting the lows. So for us to say this is a valid low, we need to see market break this side. We need to break this structure, this low. For us to say this is a valid place, so that we'll draw our trend line, we need to break this one. Okay, so that's just what we are basically looking at. So now let's go into the real chart and see what we have. Okay, let's go into the real chart and see what we have. So now this is trend line. Okay, market is making sets of higher highs and higher lows, so we know the market is in an uptrend. Okay, so now let's just see what happened here. Market pushed to the upside, and now it's pushing downward. Okay, now before we even mark this zone to say, okay, this is a place that we can draw our trend line to. All right, in the first place we need to see it break this area. We need to break this area. So once it breaks this area, we say, oh, okay, we can draw here. This it has proven that the market is going up. So now when market retraces downward now again, maybe we cash this movement, because we have seen two valid lows that will now give us the audacity to draw our trend line this way. We have seen two valid lows. Let's say this was something like this. Okay, because market has broken this, it gave us a valid reason to say this is a low. All right, so we have one, we have two. I don't know how to draw that. This is our two. Okay, this is our two, and then this is our third time. So this third time we look for reason to buy. All right, this is our third time we look for reason to buy. So our fourth time too, we look for reason to buy. Okay, until we now see market doing something like this, going up and breaking, so that we now say, oh, we can now change and say, oh, we're not supposed to be buying again. This market wants to either form something else. All right, it wants to form something else. So now before we even say, okay, we can place our trend line, for us to forecast this bounce to the upside, and we want to use this place as our trend line. All right, except we are using these two that are valid. If we want to ever use this place for do a valid trend line, we need to see the market break this high to say, okay, it's pushing upward. So we can use this to say, okay, we can keep our trend line here, our imaginary line here, and say, okay, so